And Lashondra, this will just be on my computer, so won't be shared out.
Of course.
Okay.
Oh my gosh, it's so bad.
Yeah. So once again, thank you all for joining today's session. I am Chase Jackson. My name is Chase Jackson. I'm the Director of Bigger and Better Business with the Omicron Sigma chapter of Phi Beta Sigma, Fraternity Incorporated. In these series of sessions, we want to provide a program to broaden your knowledge and provide you a new perspective on investing in your future. And with me today, I have a great financial advisor, if I do say so myself, Lashondra Strother Wiley. She is a partner with Edward Jones and has all the credentials you would ever need. Lashondra, I will let you introduce yourself and get us started.
Awesome. I will. And with that, I will also share my screen, right?
Yes, you will.
And
Well, Lashondra, while you're doing that, I'm going to make one last. So everyone in the chat, if you go to the chat for me, I placed two links in the chat. The first one is just your welcome, and then the link there is for the workbook that you'll need for today's session that Lashondra will go through as well. The second link I'll cover again at the end is for Q&A or just feedback over tonight's session as well. So just those two links are for your knowledge. All right, and thank you, Lashondra.
thank you. Thank you. And can you see my screen?
Yes, I can.
First one. Okay, great. Well, though I'll go back first and I'll show everyone the workbook will look like this in the email, right? And this is just for you to take notes and kind of follow along with me, right? And keep with you. So hopefully you see this. And of course you can put it in the chat or notes, right? And Chase can send it to you. So this is where we're gonna, roll up our sleeves and write down, and then you can have, if there's some questions you think about, you can just write them down on your blue line or what have you. Okay. So we'll get into this since we'll probably be 30 minutes of commentary, and this is at a high level. I'll introduce myself. My name is Lashondra Strother Wiley. Yes, thank you graciously, Mr. Chase. And just letting you know, I am with Edward Jones. I am a partner with an Edward Jones advisor. I'm located in Arlington, Texas. And I've been a big part of the community about 20, 25 years here in the city and the Metroplex of Dallas-Fort Worth. But I've been an Edward Jones advisor here for a little over 11 years. And I became a financial advisor just because really I was passionate about investing and helping people, especially making a difference in our community. A big part of my work, I enjoy just helping clients meet their financial goals. Gives me an opportunity to change lives. To accomplish that, I get to know my clients and understand what's important to them. Okay, so we're going to get started and go over some opportunities to learn more. And I'm going to do this at a high level, but you will be able to engage with me, and maybe if you have some questions in between too, I'll ask. But Edward Jones itself, just to kind of let you know about financial institutions and what we do, Edward Jones is a purpose-driven, team-oriented organization. And what I mean by that is that it's our belief that every person deserves an opportunity to thrive. That's why I say I found Edward Jones and they found me, because I needed a firm that would allow me to really make a difference in my community. So through my experiences as a financial advisor, I've worked with many investors who have investment goal needs like you all might have, right? And I'm here to help you achieve those goals. That this 30-minute time or so we'll have in this space, and I'll have some time for some Q&A. It's designed to help you make the most of your relationships with your advisor, or increasing your knowledge beyond your current investments. Okay, I'm glad to be here today because I've been wrestling with a respiratory infection and flu and everything for about 2 weeks, and I finally got my voice back. So I'm happy that he's allowed me to be able to speak to you today. But hopefully this will equip you with some information that you can take back. You can ask questions relevant to your situation to help your investment profile. Okay, so let me start by discussing the 5 steps, what you see here on the screen. Okay, those can help you start achieving your goals, to have a clear outlook on your future. You should first evaluate where you are today. Number one, okay? You're the only one that can do that. Begin setting some clear and measurable goals that you like to have. And once you determine what these goals are, you can evaluate whether they're realistic based on your time horizon, based on your needs for investments, and what makes you comfortable. A trusted financial advisor can be valuable in all of these, decisions that you have to make, because they're very serious. It's a serious time. And I know it can be scary too, because something we're all in different time frames in our life. And, from, I don't know, maybe 20, 30s, early career to maybe thinking you're closer to retirement. So it's important for you to understand what's going on, right? And how you can stay on track with regular portfolio evaluations. So for instance, or with a Edward Jones advisor like myself, it will help you to reach your goals. You got to know what your goals are, first of all, what new goals you would like to achieve, and is your current strategy working for you? Or do you need to make some adjustments? Okay. And I'm pleased to present this, broadening your knowledge on investments. This can give you a little more tools in your tool basket, right? And some strategies for your financial advisor for when to have some recommendations and be confident when you're there on how your money's being invested and what you can do what it can do for you. So let's get started with some basic, firm principles when you're looking at that. Okay, so I'm gonna go here. So we focus on the individual advisor, or investors, I'm sorry. So what is that? Most investment firms have principles that probably sound like every other firm. I mean, it's some commonalities, but one of the things, for instance, that makes us different is the principle needs to be created on you. You first, the individual investor. It always has to be in mind, making sure that your needs are being met first. And we have offices that are in neighborhoods. For instance, I have my office is in center of what's called downtown Arlington. There is a downtown Arlington, and you want to be in a place where people live and work. So it makes it easy. But of course, I can be spread out throughout the country on a platform like Zoom, right? But it does allow you to have a personal one-on-one experience. So everything that's done is unique. So I want to make sure you know that it's important to understand what your goals, your dreams, your hopes, your wishes are. Okay. And with thousands of people here that even I've run across, I've helped, the key is having some good technology to support the office. So we have that, a great reputation, and a respect for our investments and making sure it's appropriate for you. So our firm was built on that solid reputation. We handle about 7 million investors and 2 trillion in revenue. Right? So you also might notice that one of the things is there's, if you're in the media, there's always something hot. Right now, you might be hearing about AI. Okay, that it's hot, but is there some space for maybe some leverage in that? Maybe we can talk about that. But one of the things is I want you to notice, though, when you really want to get to retirement, you don't just look at the quick rich opportunities in investment. Usually, people are successful. They stick to some proven, solid, long-term strategies. Okay, we don't believe in chasing what's a fad. You want to create a comfortable retirement or pay for kids' education, building a legacy for grandkids. Those are the things that I believe are critical here in the firm, and keep it comfortable for investing. Look at your risk and make sure things are tailored for you. So to sum it up, we're going to focus on you, which is you, the investor. Okay. Those are the principles. That's the long term. And then the key relationships is that. all aspects of business support. Everything you do should be aligned and understanding what helps meet your goal and your family's goal. Okay, what it boils down to is that you have to find a firm that can deliver that and make you feel and understand what your needs are, that they know you. And then long-term investment philosophy. Okay, our philosophy emphasizes quality and diversification. Striving to avoid investments that make things confusing and are likely to disappoint you because they don't give the results. Okay, so you don't want that. And relationship is key as well. And that really is based on understanding what's important to you and unique to the individual. To drive, to really dive deep into your goals, and you can partner together, create a meaningful relationship, comprehensive investments. And that's the hallmark of the service that I provide. And it gives you a great sense of confidence in the process. Okay. So when we talk about number one, what you should be doing, okay, we're going to go over developing a strategy. So before I get started and move on, does anyone have any questions? So we don't have, don't have to worry about 30, 40 people. Does anybody have any questions before I get started? Okay.
I'll ask a quick question. Do you recommend any books someone can read if they are interested in, I guess, getting started in investing?
Yeah, that's a good question. There is a couple of books on it's called like Financial Basics. I have to look and see who the author is. I'll look it up in a minute. But you can get there's a book called Financial Basics, and Be Your Own Bank is another one. Okay, how to be your own bank. I believe in that one because it's important to know the opportunities you have when you start an investment account. Talking about more margin, you can even use things for margin loans and lines of credit. And you hear the high yield is out there a lot right now. What does that really mean at a bank? Typically, to get that high yield, you need $250,000, right? To get that over 5% people are looking for. You want firms that really can work with you. Like we started $250. Even I got a notice from Bank of America saying, you needed 250,000 to get 4.65, but you have some money markets when you give it a brokerage firm that they have that already, and the minimums are very low. So knowing things like that, okay, and some basic tools. So, but I think this is a great place to start the introduction of understanding then what your why is. So to answer the question on developing a strategy, that's basically understanding what your why is. That's the foundation of an investment strategy. That's unique to you. Okay. And then get help in understanding the strategy behind the how. So I know your why, then the how. So today we're going to discuss the 6 basic rules to help you form a strong foundation in investing. Okay. And those rules are first to develop a strategy. And then we're going to stick with quality, diversify, invest for the long term, and focus on what you can control. And always, always keep learning. So that's part of those books Chase is talking about, getting the knowledge, right? So there's several tools to consider as you develop what your overall strategy is. By understanding the foundation of investing, it's better to be equipped with these tools and be wise with it. So many of you may be investing first through your employer-sponsored 401k plan, or maybe a 403b, which is a good way to start retirement. Okay, many companies match retirement contributions, such as 50% of your contributions or 6% of your salary. You should take full advantage of that. At least contribute enough to get the full match. We never leave money on the table. Okay, that's investing 101. Okay, that's the first thing. However, when it comes to retirement, though, you want to invest beyond that employer sponsored plan. Okay, you want to have other saving goals that are outside of a 401k, additional retirement plans, emergency bucket. You might hear Roth. Okay, and really probably it's hard to think, how do I get started with that? Most investors, they make their money over time. They don't make it overnight. That's like they say, like getting into the NFL or the NBA. It's, it's a 1 in a million. It's better odds of getting hit by a Mack truck, right? It just, those overnight quick rich schemes and podcasts, things you might hear, don't believe it. I mean, it's not likely going to happen that way. You do get an opportunity with 1 or 2 investments that might really soar, but it's really the steady quality that builds and compounds. And that's what some of the guidelines of things and how we'll talk about that. Okay, the rules of investing. Simple, but it's not always easy to follow. Okay, because it takes discipline. And I always talk about it takes time, discipline, plus quality investments. That's what equals RW. I call it the rich and wealthy. Okay, those are the keys. They are simple, but it's very hard for people to do. So we'll review some of these rules and kind of go over that. All right, so let's look at it. So that's developing a strategy. Okay, so then let's look at your investment strategy and determine like long-term goals. We think about some of you may have goals to help pay for your child's education, let's just say 10 years from now, right? And you've always been thinking about your retirement. If you could have a very different focus on that long term, when you talk about temporary market declines, or you might find it hard to say, no to a new investment, that might become, temporarily popular. But as you make investment decisions, your strategy will help you stay focused on the long term. So it'll be easier for you to stay on track and achieve your long-term goals, okay, on the long term. So understand your risk tolerance and keep focus on strategy. Risk tolerance refers to your willingness and your comfort level. It's if you get fearful or scared, then maybe you don't need to be maybe in all stocks and things like that. So that's what understanding your risk tolerance. How do you feel when the market's up and down? Okay, what does that really mean? So it's important that you have a questionnaire that you kind of fill out. It's really like a psychological test. It helps you, it gauges your risk. That's a strategy that you should always use to kind of know how you feel with the ups and downs in the market, the short-term volatility, because it doesn't last always. Okay, so finding that balance, that's what's the key. It's important to do that in your strategy. Okay, and as mentioned earlier, when we look at tips of the day or hot topics that you hear, the best advice I can offer is to ignore them. That's what I can tell you. At Ever Jones, we're not big on investment fads, such as some real estate. Real estate's good, and I believe real estate too, but there's some fads and some things you hear, or they'll tell you to move all your 401k when you retire into these estate programs, or gold, thinking the world's going to end and put it in gold. Don't do that. Okay? Don't do that. In our experience, these investment success just depends on holding on to quality, well diversified. It's not a sprint, it's a marathon, and just keep that in mind. So let's look at number 3, diversify. Okay. No single investment performs well under all conditions. I don't care how good it is. I'm not going to name a few names. There's been some things lately that people thought I'm going to put all of this in this certain technology. And people remember Enron from maybe years ago, but nobody really lost money unless they invested everything in that. So you never put a large portion of your portfolio in a concentrated type of investment. And bad news causes values to drop unexpectedly. Okay, so your long-term financial strategy could be in jeopardy if you're thinking everything should be in one area because maybe you read that's high. You don't do that. It's important to remember that diversification won't guarantee you make a profit or keep you from losing money if you take it out right then. But investing doesn't always involve just guarantees. It's getting to the course of where you want to be. But as I said, it can reduce the risk. That's the key. Longer time horizons, staying invested, not spending all your assets, needing if you're needing to sell off large portions when the market's down, looking at your 401k all the time, thinking you need to change when it's down. Don't do that. That's not a strategy. Allocating your assets effectively is the single best way to improve. Okay. And you can make, little tweaks here and there. There's a major study of factors that determine financial returns. Show that over 90% of variability of returns are determined by how you allocate your investments. This means that the difference of your returns from year to year, and the more important the difference in the risk that you're taking is largely related to asset allocation. And all that means is not putting all your eggs in one basket. Okay, diversifying them. As a result, if the more you have asset allocation, the much bigger your impact is on the success of your portfolios and the time in the market. By buying, selling stocks, they already have money management in it. That's what helps you in those low points and the highs. So asset allocation is also more important than different types of investments you choose. It helps you to illustrate the concept of the entire aspect of your investments. Okay, it looks like a pyramid. Okay, you have what's in the high, what's at the peak is those high, research development companies all the way down to maybe the conservative low. So when we talk about investments, you want your cash as your foundation. Then you have income, large cap equity. Then you have small and mid cap equity at the top is the aggressive. So it's always built like a pyramid. Okay. So that's the level of investment. Your cash and your savings is where you start. It's where you level things. Okay. And then what you do is from there, you have, say, your savings, your checking account. You have money markets or short-term CDs. This money will keep you in your day-to-day expenses and maybe tempt you from not going into that basket of your long-term investments. Okay? But you're looking at how you can get the best interest rates on those savings. Okay, that won't earn you, that won't get you to that wealthy, rich point, but it does help you earn interest on your tangible investments that you need to touch right then, and help level off low risk investments that are still making money for you. Hopefully, I hope that makes sense, right? And we can get deeper on this later. Okay, and the next level is made up of investments that pay income, such as CDs and bonds. Okay, so you have your cash, then you have your CDs and bonds. These investments typically provide a moderate but steady level of return. They provide some stability in the foundation of your portfolio. Stocks fall into the upper portion, and I call that the belly of your investments. When we look at a pyramid, it's the belly. That's the meat. That's where your larger portion really should be. The higher you go up in a pyramid, the more level increase you have of some risk, meaning volatility. However, it does mean that you have a better opportunity for returns. That's the great news about it. Okay, so it's important to make sure that you have the right mix of your income and your growth to pay for, for your current expenses and to keep up with inflation. I don't know about you guys, but you've been to the grocery store, and I mean, a steak on sale was $9. It's like, it's $9. I was like, ooh, $9 for a T-Mall. My husband likes beef, so it's like that's a sale. It was probably 2 years ago. That's inflation. So that is why your money has to work for you. That is why you have to stay invested. So does anyone have any questions on inflation? We can keep talking about diversification.
And guys, feel free to take yourself off of mute if you need to.
Any questions? We can't hear you, Frederick. I see your lips moving. Can't hear you.
I see he put something in the chat. Let me go there.
Okay.
He said, "How much money would I need to start investing for grandkids?"
For grandkids, usually like a mutual fund, $250. And you can then put money in minimally for us, it's $50 a month. That's what most fund companies now. Back in the day, we used to be able to put 25, but you can start with $250 and then $50 a month. Okay. I hope that helps. I see you nodding. Okay, good deal, good deal. So but the mixed, income growth, it all depends, like I said, on your situation. But you look at asset allocation, spread it all out. So let's explore some of that a little more, because on bonds and a variety of bonds. When you hear about diversifying your portfolio, that simply means owning a variety of investments, such as individual bonds, stocks, and packaged investments. Okay. And not being over concentrated in any investment type based on the risk tolerance and your portfolio objectives. For example, let's say that you invest in bonds. Bonds are debt securities, okay, like your mortgage, right? They're debt, similar to IOU. When you purchase a bond, you lend money to a company or a municipality or a state. You can actually own all these too. U.S. government, finance, variety of projects and activities. Basically, we vote when we do that. Those are those bonds and municipalities. Now, next people, have you ever thought about owning those? You can buy those. Basically, as an investor, you're lending your money to an issuer, and the issuer agrees to pay money back at a specific date in the future. Your choices generally range from day-to-day short-term investments. They could be 30 days all the way up to maturing in 30 years and making income. And then you get your money back. Okay. So, but bonds do have minimums, and those minimums are typically $5,000 investments. Okay. And then you can buy them in increments of 1,000 after. So when you think about that, however, it doesn't mean that bonds purchase price is always going to be at par. And par is 100. That's the face value. That's par. Because the price of a bond is affected by changing levels of interest rate. It means the purchase price can be greater. That's called a premium. So sometimes you can buy them at a premium or less, which is a discount. It's called discount. That's par. Okay. So as I said, this is a high level, but this is still trying to understand that, right? Because in general, the longer the maturity, the higher the interest rate. The longer the term of the bond tends to fluctuate price more than the short-term bonds. So the key to understanding bonds is that there's an inverse relationship between bond prices and interest rates. The inverse. When interest rates go up, bond prices tend to decline, or vice versa. Makes sense? Okay. So look at it like this. So however the rise and fall of the bond value, that's important. But it's only if you sell your bond prior to the maturity date. It's going to fluctuate day to day. That's if you sell it. But the level of regular interest payments also won't change. Once it is determined what that interest rate is, 3%, 4%, 5%, 6%, whatever, you're going to get that. That doesn't change until maturity is over. If you sell it, then that's when you can, if the rates are up or down, that's the change in the value. Okay. So this can surprise some people. That's a bond investor if they don't know that. So no matter what the price, though, bonds can fluctuate. If you hold them to maturity date, then that's called a feature to redeem the bond. Okay. But keep it till then. So you should receive your original principal value back. That's how it works. These are typically owned to provide income. It's in low interest rate environment. You know, the primary benefit of owning a bond is that you keep it to provide some diversification for your portfolio while you increase the rate of movement. And you can actually kind of predict it sometimes, but not always. Bond prices are typically less volatile. They're going to be more stagnant, more steady. In addition to that, they provide stability to the portfolio. Stock prices, they don't typically move in the same direction. Now, 2022 was a different scenario where when the interest rates were going up, bonds were already so low, they were down, or stocks were still increasing at a better rate. And that hasn't happened to the 80s. So that is why diversification is so important. So, but we can also speak on some other things. In addition, there's another way in bonds that they can fluctuate. They're called high yield bonds. And those are similar to what are called equities or stocks, and they can be a little more volatile because they're paying a higher yield. These bonds have a higher risk. They have a different investment grade, then they generally pay more because of that. And typically we recommend, investing in asset classes, in your mutual fund structures and things like that, and for your diversification. Okay. So here we're going to talk about diversifying and why bull or bear. So I don't know if anybody has heard of the bull and the bear, and you've seen that and want to know what's associated with it in investing in the stock market. What does investing in the stock market really mean to you? You may have heard of bull and bear. And the use of the bull and the bear described in the market comes from the way animals attack their opponents. Okay. A bull thrusts his horns up in the air while a bear swipes them down, the paws down. This action is really a metaphor for the movement of the market. Okay. If the trend is up, then it's a bullish market. Right? If the trend is down, then, as you heard during the down, that was even after COVID, we were going through a correction, that was considered a bearish market. And you can look that up in the source of Investopedia. You can go to investopedia.com. That's something you can write down. That's a good source for understanding the bull and the bear. Okay? So when you invest in the stock market, you are buying into publicly traded companies. Companies that make the things that people want to buy. That is what you're doing. So what are the ways you can earn money investing in stocks? Most people invest in the stock market to earn a return on their potential investment. Of course, right? There's two ways to do this. Through a stock appreciation. It's also known as capital gains or dividends. Okay, this is the stock. So a capital gain is the difference that you pay for a stock and what you receive when you sell it, if it has grown in value. For example, if you paid $20 for a stock and then sold it for $30, your capital gain would be $10. Okay, dividends are payments given to shareholders out of the company's earnings, usually quarterly. They normally come in different quarters, okay? And they can be paid in the form of money or in company stock. Some of you in your companies might get something called RSUs, right? So they're stocks. They keep in mind that dividends are not guaranteed and can be increased, decreased, or eliminated at any point of notice. So a little bit of that happened during COVID, right? Companies like, I'm not paying dividends. Some 401ks then said they weren't going to match. Hopefully you didn't work for any of those companies. I really hope that. But traditionally, some quality investments that you can make are dividend paying stocks. I love dividend paying stocks. These are usually stocks that are well-run companies. consistently having strong earnings, not get quick rich overnight trendy. I'm not talking about those. I'm talking about stocks that they have great leadership and they pay. I don't know about you guys, but I don't know many people that have gotten a raise year after year, 30 years. Most people, they don't always get a raise year after year. But when you own companies, when you own stocks, dividend paying, there are companies, one we can name like Coca-Cola, 52 years consecutively, they've given a raise on dividends. So, those are companies dividend paying. That's just kind of one example. They give, when you own them, you can get a raise. So that's why you want to stick to quality. Of course, stock dividends can be an additional source of income to you, but dividend paying stocks offer more than income. Okay, they also provide an opportunity for growth. Companies with a consistent record of paying the dividends generally considered stable, high quality investments, as I was saying. And of course, you can diversify those. You need to. You have to diversify. Okay. You don't own just one. Stock market returns are different industries. They all can fluctuate. Yeah, I mean, if you all bought some oil and gas a couple of years ago before it went up, I'm sure you're very happy, right? They were down for several years, but then look what happened. But you diversify around it, and when it was down, you still hold it because everybody has their day. It's like every sector has their day. But fluctuations, if you have too much of one, yeah, they can affect your portfolio.
Sean, I got
So
a quick question.
uh-huh.
With the capital gains, with the money you make from capital gains, would that money be taxable if sold? Is there a certain tax rate as well?
Yes, capital gains, they are taxable, but they're not taxed as income. They're taxed based on your tax rate. So everybody's tax rate is different. If you're at the highest tax rate, then you can have 20%. That's the maximum that they can charge, or 15 or 0. It depends. It depends on your taxable income rate. And if the gain is $1,000, for instance, that you made, that $10 example here that I have up, this $10 that you earned, and you had 100 shares, let's just say, and you made $1,000. Okay. And you had, capital gains, and the gains you had, that would be a good gain. Let's just say it's $1,000. And you sold it, and that's your gain. So your gain of 20% of that would be $200 if you were at the high tax rate. But say if you were at a lower, it could be 100, it could be 10%. Got it? That's when we talk about your tax professional, and I work with your CPA too, right? You want to make sure you have that team around you. So technology industry is also a good example that the industry, when we talk about kind of the companies that have had tremendous growth and capital gains in the early 1980s, I mean, it was huge, right? But they slumped down with a slow downturn in the personal computer business and the mainframes market. So I hope you didn't put it all there. And then in the early and mid 90s, however, there were some major advances. The microprocessor technology that gave a personal computer business a big boost. And then investors returned to tech stock. And that's still the biggest area of the market here in the US, right? Then the slowing down of the economy came again. See, it's all different times and periods. 2000, 2001, adversely affected technology. So what did we have coming about then, right? The search engines, right? The tech stock prices, they dropped again. Yahoo and everything was huge, right? Mark Cuban, he had some insurance on it, and he came out billionaire today, right? Yay, go Mavs. I'm gonna go to the game tomorrow. Let's hope they win, man. So yeah, but then it dropped. So this is how companies do. If all your investments were in tech stocks, you would have ridden a roller coaster. If you had some tech stocks and then you had some other industries, it might not have made you scared, because I guarantee you, if you probably had them, then you probably would have sold them at the wrong time. right? Your portfolio would have been more stable if you have things also built around it. So we've talked about bonds, we've covered stocks. Next, we're gonna discuss some things called package investments. That includes mutual funds. Kind of what I was talking about, those 250 minimums. Because stocks are different too. Your stocks, but we were talking about his grandkids accounts, but then you can buy stocks systematically too, monthly. But then we also, when we talk about it, package investments, those are going to be exchange traded funds, ETFs. They were created by Warren Buffett, right? So the thoughts of each packaging the hybrid, it's like a hybrid between a stock and a mutual fund. And there's also something called unit investment trust and similar types of investments. But first, take a breather, and for me, I'll get some water. Does anybody have any questions? Try to get through this and keep our time. Okay, good. No questions. Package investments. Let's talk about those. Okay, let's start on understanding what package investments are. Package investments such as mutual funds, exchange traded funds, unit investment trusts, they invest in a variety of stocks and bonds or a combination of the two. So you can receive certain types of built-in diversification. It's all built into that one, right? When you invest in one of these, your money is pooled. So I'm saying it pooled, right? With other investors. Okay. And I always say it's like a swimming pool, right? And everybody's in. Just because you have one more mutual funds and ETFs does not mean you're properly diversified. Okay. However, you need to make sure your asset allocation, the number of stocks and bonds you own, are diversified as well. For today's purpose, though, we'll discuss mutual funds as an example of a package investment. Because I know this is, I'm giving a lot in the beginning of just understanding this at a high level. A good way to diversify by industry or asset class is to buy quality, professionally managed mutual funds. A personal money manager or a money manager team invests the money into a variety of securities to help you kind of fund or meet the stated objective, such as growth in the growth in income. Okay, so they do that for you. That's the benefit of mutual funds. So that there are some benefits, to that. That's what they are, because they do it for you. They just need to be selected properly. Unlike other investment, mutual funds can be appropriate investments for large or similar, for smaller sums of money. You can have, like I said, that $250 and have it all diversified in 100 companies. That's how you can do it without buying them individually. Okay, that's the aspect of it. So diversification. Most funds diversify their holdings by buying a wide variety of those investments. Like I said, you might typically, a stock fund would have 100 or more companies, provide a range of investments. You can take advantage of that for furthering your diversification. Okay, that's the beauty of owning those. However, please note again that diversification does not guarantee a profit against loss. Profit or protect you from that, right? Because if you need it or sell out of it on a time, it could be down at that time. That's the thing. So there's no guarantee of that. Okay. And if you hear background, I'm sorry. Let me close my door. I think they're cleaning in my office. Did you hear that background noise? Is that okay?
Wasn't bad.
Hold on just a second. Let me close the door. Okay. Sorry about that. I am in the office. Okay. So let me, for time purposes, I'm gonna go back to professional management, kind of understanding that it takes the burden off you identifying what investments, okay? That's why you want that. So we're gonna go into kind of the earnings, how that works. So I'm looking at our time here, trying to keep the time. So mutual funds and earnings. What are the ways that you can earn money from the investments in the mutual fund? Okay, if there are bonds in your mutual funds that can earn you interest, okay, and if there are stocks within the fund, they can pay dividends. The mutual fund will subtract its expenses and pass through earnings onto to your dividends. That's the difference about mutual funds. So what I'm saying is you don't necessarily have to sell the investment yourself, but their sales are happening inside of it. That's what automatically can distribute out those dividends. So the second way you can earn is for the share price of the mutual fund to increase in value. When a mutual fund manager, sells the security within the fund, a profit, a capital gain is realized. Any gains are periodically paid in the fund, and the shareholder then gets that capital gain distribution. Okay, that's the way it's done. So if you've ever noticed you've owned some of those and you didn't sell it and you wonder why you had to pay those capital gains, that's why, because there's things behind the scenes happening. And you've heard me use the word risk a few times during this class or this seminar. You probably are aware that, like most other investments, mutual funds have risk associated with them too, and those risks will vary depending on the type of fund. But some general principles they typically apply, and that's just have quality mutual funds as well. For example, a mutual fund might have they might have to sell a bond at the current market price. And if the bond is called by the issuer, and that means it's called in early, it can there are instruments that have calls on them. And if the bond market price is down, the mutual fund may experience a loss. So on the other hand, the stock owned by the mutual fund may fluctuate in value due to the market conditions, causing the value of the fund to fluctuate as well. So because of the fund's that's what the risks are, the different kinds of risk. A mutual fund company can't guarantee the results. But generally, if it's diversified enough, it does know on the average how it will perform. And then you also have things that are called advisory programs where investors are looking at a level of diversification and personal management beyond a mutual fund. They might consider something called a fee-based program, or some people call them wrap programs. And generally, these programs use investments that are professional. Like myself, they may be selected, and we have analysts that continually review it and make appropriate programs for you. So just to pause for a moment, any questions? Anything we talked about this so far? Okay. So you have to buy and hold. You hear that yeah, any questions? Okay. So all these things we've talked about so far are they fall under the categorization of buying and holding. Those are one of the core beliefs that we even do here at Edward Jones is buy and hold strategies. That's what that's called. And all that is things that we kind of talk about investing for the long term. Okay. That's why you invest. Okay. You bring those strategies to, long term. They help you to stay on track, keep the 5-step progress, going and things like that. So I'm going to kind of go into, I'm going to skip a little down because I'm looking at our time again, keeping this on track. I want you to remember your strategy needs, the strategies that you need to help provide for not only you or your family goals today, but not only that, it's goals that you want maybe 25 years from now, longer. So many things can change from year to year. Okay, so it's important to talk regularly and make your needs known and met, to make adjustments on your regular investments. That's a good opportunity for you to make sure you also have your beneficiary designations. Put all of that on your accounts. Keep them up to date because anything can happen at any time on all your banking. Make sure that you have beneficiaries on your banking accounts, on your 401ks, on everything so they bypass probate. Okay. Let's do that. Okay. So let me ask you, even before the recent market volatility we had, how many of you ever felt a little uneasy about the stock market? Again, yeah, okay, hands raised, yeah. All right, all right. Well, I'm sure that's coming. You know, I get nervous. What's going on in the stock market? Well, since 1937, okay, the U.S. has experienced war as well as economic, political uncertainty, you know, upheaval. We had the Depression. Despite the setbacks, our nation and our financial markets, they preserved it, right? The companies, they're good companies. They made it through, even through the 1930s, which was the worst decade of stocks and stock market. Basically, it broke even, right? In fact, in 2009, it marked the end of one of the worst decades ever as stocks fell and had an annualized 1%, you know, return. Second only to the decade ending in 2008. However, a difficult 10-year period has historically followed a very strong performance. So what you have to understand, 13.1% on average per year. Of course, the past performance of the market is no guarantee as to how it will perform in the future. But after every downturn, there is normally a upside, good turn. After the correction we just had, one of the best times to be in the market is usually after the downturn. You have one, typically 3 years up. So you need to make just some minor changes and keep everything aligned. So it's a great time to take advantage of systematic investing in your portfolio. Okay. Although systematic investing does not guarantee to protect you against loss, it helps. You buy when prices are low. You buy them for fewer shares. You buy fewer shares when they're high. So you want to buy more when they're low, and you can get more. And if they're suitable, then gradually you get the upside out of the price. So this chart I have up demonstrates how you can decrease how you could potentially decrease the price you pay for shares. You purchase them over time rather than a lump sum. The first example is $5,000 lump sum invested. Okay, a lump sum investment at a $20 a share price. The second example assumes that you paid $417 monthly for your investment over 12 months. Various prices every time you purchase it, right? And this example of the lump sum, it produces the ending balance of 250 shares, which were purchased at that $20. But the dollar cost averaging strategy, you do this a lot in your 401k, investing $417 per month, purchased a total of 300 shares. That's why you do that. During the year, an average price approximately of $17 per share. In the scenario, the investor purchased 50 more shares on the average for that average price that with because of the $3 lower than the lump sum. Does that make sense? See, that's why you dollar cost average. And so I'm gonna get on to focus on what you can control. So through all of this, okay, you have to focus on what you can control. Okay, control your savings, your spending habits, so you're more prepared for the rainy days. Okay, while it's not an attractive word, budgeting, you need to have a budget. I like that. When you're spending, always know, increase your savings. This is a good start. That's a good spot to just remind everybody the importance of keeping your household budget. Commit to monthly expenses on paper, electronically, budget sheet. I get you one. That's a vital part of staying on track. Okay, so on that note, we're at our time. I want you to manage what you can control. You can't control interest rates. Remember that you can't control taxes. You can't control the fact that investments are gonna fluctuate. Okay, but you can stay diversified. Okay, you can't control the way the taxes are going to change, the taxable areas, but we can be prepared for that. And you can learn more about your own risk tolerance and control that. Okay. And just be ready. Be prepared for the setbacks. Okay. Be prepared for them. Okay. And just to take a minute, I'll just let you know what we have to offer too as a segue kind of in closing. You can visit our Edward Jones Financial Fitness and download this on your mobile app. This is for a digital education. It's a platform that's available for you. It's no cost to our clients, investors, our community, family. This is online content. It'll help you maintain solid understanding on basics of personal finance and investing. Consider sharing this, with your aging parents and next generation on topics. Know what your social security number is. You can go on ssa.gov. Okay, you can get that. Know what your number is for where you retired 67 to back into the numbers on what you need. Okay, and I could say when you get started on this, it does have like 40 brief, I think, interactive financial education modules on it, and you can go through that. And then in summary, these are the rules. I've given you the rules. There's 6. Develop a strategy, stick to the quality, diversify, invest in the long term, right? Focus on what you can control, and always, always, always keep learning. Thank you. I'm 3 minutes over. We started a little late, but I thank you all for coming. And please fill out the evaluation and tell me what you think, and survey, tell me what you want to hear, and what you didn't like hearing, or if I talk too fast. I'm from Mississippi, I'm sorry, but I had a lot of things I want to share in this hour. But please complete the survey form and let me know how to get better, since this is our first time doing it like this on this platform. Any question?
And I'll cover just a few things. Once again, thank you, LaShondra, for your services and for volunteering your time. Everyone in the chat, there's 2 links. The first link is for the workbook that she went through today, broadening your knowledge for this particular session. The second link in the chat is a survey that will cover today's session. Once again, just how you liked it, general feedback as well. Also, I do want to share my screen real quick, and LaShondra, we'll go through this together.
Okay, I'll stop the share.
So I want to make sure this is clear as well. Can you all see my Facebook screen here? LaShondra, is that screen clear?
Yes, I see it. Yeah, I see the dates, and we need to make sure we change that 15th.
Yep.
Right?
We'll do, yes. So coming up next, on the 15th, this is Wednesday the 15th, not Thursday. On Wednesday, May 15th, we'll cover retirement by design. So she'll dive into 401k, pension, RA, and UILs for those who don't know what that is. After, it'll be rules of the road. So general knowledge over business planning and exit strategies, especially for those entrepreneurs out there. That's Thursday, May 30th. And all of these times are Eastern Standard. After, preparing for the unexpected. So creating your estate plan, stocks, that week after, stocks, the nuts and bolts, and then focusing on fixed income. So all these, of course, are for the general public. So pick a topic that interests you and send it to somebody who may be interested in these topics as well. But once again, on behalf of the Omicron Sigma chapter, North Dallas Sigmas, I do thank you for attending today's session. And before we go, if we have any questions, feel free to take yourself off of mute or put something in the chat. And I'll allow just a few minutes for that before we get out of here today. All right. So hearing none, all right, once again, thank you all for joining, and LaShondra, we will catch up for the next meeting, and this was a great presentation today, so thank you once again.
Thank you. I hope I wasn't going too fast for you, but enjoyed it.
So
Love teaching.
thank you.
Thank you.
Good night, everyone.
Good night.